The Dow Jones, Nasdaq, FTSE 100, three of the major stock indices, a hugely important part of our financial world. Yet a stock index is nothing more than a number representing the top shares from a particular exchange. Take the FTSE 100 for example. It represents the largest 100 companies traded on the London Stock Exchange. If on average the share price of these companies goes up, the FTSE 100 will rise with them. If they fall, it will drop. Now in the US, as well as the Dow Jones and Nasdaq, you also have the S&P 500. In Europe, there's the DAX and the CAC. And in Asia, the Hang Seng, Nikkei and ASX. Most of these are calculated using a capitalization weighted average, which means the size of each company is taken into account. The more a particular company is worth, the more its share price will affect the index as a whole. The Dow Jones and Nikkei, on the other hand, they're examples of price-weighted indices, where shares with higher prices have more influence. That means a stock trading at $100 is giving 10 times more clout than one at only $10. So now you know what stock indices are. How can you trade them? Well, since indices are simply numbers, you can't buy or sell them directly. You have to choose a product that mirrors their performance. Index funds, exchange-traded funds, futures, options, CFDs and spread betting all do this by tracking the price of the underlying index. And because they're made up of so many stocks, the value is always shifting, meaning indices are often more volatile than individual shares, providing traders with multiple opportunities but also increased risk. So remember, when trading stock indices, it's important to do your research and use risk management tools where appropriate.